Today, something unusual is unfolding in the silver market, and the majority of investors still have no idea how serious the situation may become. On the surface, it looks like another volatile week for a precious metal that has always been known for dramatic price swings. But beneath that surface, deeper forces are beginning to collide. Silver recently surged to an extraordinary level of 96.93 before rapidly collapsing nearly 11% to $82.46. After that violent move, the market stabilized at a level that traders around the world are now watching with intense focus. The reason this moment matters is not simply because of the recent spike and correction. It matters because the market is approaching a point where supply constraints, technical pressure, and geopolitical tension are all converging at the same time. When those forces collide, the outcome can reshape an entire market. To understand why silver is suddenly attracting so much attention, we need to start with what happened during the recent surge. The metal did not slowly climb toward $96.93 through a steady trend. Instead, the price accelerated rapidly, driven by a combination of safe haven demand and speculation that global tensions could disrupt financial markets. Such rapid moves often occur when investors rush toward assets they believe can protect wealth during periods of uncertainty. Precious metals have historically served that role, and silver tends to amplify those movements because its market is smaller and more sensitive to sudden shifts in demand. When fear enters the system, prices can rise with astonishing speed. However, the spike was followed almost immediately by a sharp correction. Profit-taking began as traders who had entered the market earlier decided to secure gains before volatility reversed the move. Within a short period of time, the metal dropped about 11%, falling to $82.46. This sudden reversal created confusion among many investors. Some interpreted the drop as proof that the rally had been exaggerated. Others saw it as a temporary pullback inside a much larger bullish structure. But while most people focused on the chart itself, a far more important development was quietly unfolding behind the scenes. The exchange responsible for the majority of global silver futures trading has begun experiencing stress that few people expected to see. Reports indicate that trading disruptions occurred when sell orders briefly exceeded the physical inventory available for delivery. That detail may sound technical, but it reveals something extremely important. The silver market operates on a system where contracts representing large amounts of metal are traded every day. These contracts theoretically allow buyers to receive physical silver if they request delivery. In practice, however, most traders never take delivery. They close their contracts for cash or roll them forward into future months. Because of this behavior, the number of paper contracts circulating in the market is vastly larger than the amount of physical silver stored in vaults. For decades, this system functioned smoothly because only a small percentage of traders ever requested the metal itself. As long as that remained true, the exchange could support massive trading volume without running into supply problems. But that balance appears to be shifting. More participants are now demanding delivery of actual silver instead of simply trading contracts. When that happens during a period when inventories are already tightening, the system begins to feel pressure. Registered silver inventory represents the metal that is specifically available to fulfill delivery obligations tied to futures contracts. This inventory acts as the foundation supporting the entire futures market. If it becomes too small relative to demand, the stability of the system can be threatened. According to recent reports, the registered supply is struggling to keep up with delivery requests. Trading freezes that occurred recently were a direct result of that imbalance. For a brief moment, the number of sell orders exceeded the metal available to back them. That situation exposed the fragile relationship between paper contracts and real physical supply. This is the development that makes the current moment so important. For years, analysts have discussed the possibility that the silver market might eventually face a situation where the physical supply could not easily support the enormous volume of paper trading. Until recently, that concern remained mostly theoretical. Now the first signs of real strain are beginning to appear. When an exchange responsible for global price discovery experiences disruptions linked to inventory shortages, investors start asking deeper questions about the true availability of the metal. Before going further into the implications, it is important to clarify something. Many people discussing financial markets online attempt to promote paid courses, signals, or mentorship programs. That is not happening here. No services are being sold and no trading instructions are being marketed. The purpose of this analysis is simply to explain what may be developing inside the silver market so viewers can evaluate the information themselves. Anyone claiming to represent this analysis while offering paid products should be ignored immediately. With that clarification in place, we can turn to the broader supply and demand picture, because this context is essential for understanding why the delivery situation matters. According to data published by the Silver Institute, The global silver market has experienced 6 consecutive years where demand exceeded supply. That means 6 years in a row during which existing inventories had to be drawn down to compensate for shortages. The deficit recorded previously was estimated at approximately 117.7 million ounces. Analysts now expect another deficit of around 67.2 million ounces to appear in the near future. These numbers are not abstract statistics. Every ounce required to fill those deficits must come from somewhere. The metal can be sourced from above-ground stockpiles, exchange inventories, investment funds that hold physical bars, or private reserves accumulated over many years. But continuous deficits slowly reduce those sources. When shortages persist long enough, inventories that once appeared abundant begin shrinking at an accelerating pace. The situation became even more complicated when a major producing nation introduced new restrictions affecting refined silver exports. As the world's second-largest producer and a major refining center for global markets, any change in that country's export policy immediately affects international supply. When the restrictions were implemented, a substantial flow of refined silver that normally entered global markets was suddenly reduced. A supply deficit that was already challenging became significantly tighter. At the same time, demand continues expanding from multiple directions. Industrial consumption of silver remains strong because the metal plays an essential role in modern technology. Solar panel manufacturing, advanced electronics, and medical applications all rely on silver's unique properties. As global production of renewable energy technology accelerates, the amount of silver required for photovoltaic cells continues rising. Each new installation of solar capacity consumes small quantities of silver, but when multiplied across millions of panels, the total demand becomes enormous. Investment demand also remains robust. Retail buyers across several regions have been purchasing coins and bars in large quantities, often paying substantial premiums above the official spot price in order to secure physical metal. These premiums reveal something important about market psychology. When investors are willing to pay more than the quoted price to obtain physical silver, it suggests they believe the metal itself holds value beyond short-term trading activity. Another factor beginning to influence the market is the emerging interest from central banks. Traditionally, central banks accumulated gold as their primary precious metal reserve asset. Silver rarely appeared in official reserves. Recently, however, some emerging market central banks have begun diversifying by adding silver to their holdings. This shift reflects a broader trend, where governments seek assets that cannot be frozen, sanctioned, or created through monetary policy decisions. Physical metals provide that security because they exist outside the digital financial system. Central banks behave very differently from ordinary traders. When they enter a market as buyers, they usually accumulate metal slowly and consistently rather than reacting to short-term price movements. Their goal is not speculation, but long-term reserve stability. That type of demand tends to absorb supply regardless of temporary fluctuations in price. When all these forces are combined, the picture becomes clearer. Industrial consumption is expanding, investment demand remains strong, and central banks are beginning to participate as buyers. Meanwhile, the supply side faces persistent deficits and new export restrictions that reduce available metal. Under normal circumstances, such an imbalance would eventually force prices higher as the market attempts to restore equilibrium. But markets rarely adjust smoothly. Instead, they often pass through periods of intense volatility before reaching a new balance. That volatility is exactly what the silver market is experiencing today. Prices surged rapidly, corrected sharply, and now hover near a critical technical level that could determine the next major move. Understanding that moment requires examining not only the fundamental supply shortages, but also the technical structure that traders are watching closely. Now that the broader supply pressures are clear, the next step is to examine the technical structure of the silver market, because this is where traders around the world are focusing their attention right now. After the violent spike toward $96.93 and the equally sharp drop to $82.46, silver has moved out of the chaotic phase of panic trading and into a structured consolidation. The wild momentum that pushed prices vertically has faded, and in its place, a more defined technical battlefield has emerged. This battlefield revolves around one level that has become the center of attention for traders, institutions, and algorithmic systems alike. That level sits near $85.40. At first glance, $85.40 might appear to be just another number on the chart, but when several major technical indicators converge at the same price zone, the market begins to treat that level as a barrier that must be broken before momentum can continue upward. In this case, the 50-period and 100-period exponential moving averages are both approaching the same area. When moving averages align like this, they create what traders often call a resistance cluster. Price can approach the zone, test it, and even push slightly above it. But until the market produces a clean and convincing close above the entire cluster, the resistance usually holds. Before silver even reaches that barrier, however, the metal already demonstrated where buyers are willing to defend the market. During the recent correction, the decline found a floor around 82.31s. This level was not random. It aligned closely with the 0.236 Fibonacci retracement of the rally that pushed prices toward the high near 96.93. Fibonacci retracements are widely watched because they frequently mark areas where buyers attempt to re-enter a market after a sharp move. When silver touched that level, buying pressure immediately appeared. The market stabilized and refused to collapse further, despite the panic that had just swept through the system. That stabilization marked the transition from forced selling into a stage known as price discovery. During the earlier drop, many positions were liquidated quickly as traders reacted emotionally to the reversal. Once that wave of selling exhausted itself, the market began searching for equilibrium. Price discovery is the process through which buyers and sellers gradually determine what the metal should be worth after a period of extreme volatility. It is a slower, more deliberate stage of trading where the market tests different levels until it finds a balance between supply and demand. Technical indicators provide clues about how this process is evolving. The relative strength index, for example, plunged into oversold territory during the sharp decline. That reading indicated that the market had reached a point where selling pressure had become excessive. Since then, the RSI has been climbing back toward neutral territory. A recovering RSI suggests that the panic phase may be ending and that buyers are beginning to regain confidence. However, the indicator has not yet crossed decisively into bullish territory, which means the recovery remains incomplete. Another important indicator, the MACD, continues to show signs of weakness. The MACD line remains below the signal line and still sits within negative territory. When this occurs, it signals that bearish momentum is still present beneath the surface. While the market may be stabilizing, sellers have not fully lost control. This combination of recovering RSI and weak MACD explains why the current phase feels uncertain. The market is no longer collapsing, but it has not yet regained clear upward momentum. The structure of the price chart also reveals this uncertainty. On the shorter time frame, silver has been forming a pattern of lower highs. Each rally attempt stops slightly below the previous peak. This pattern is often interpreted as building downward pressure because it shows that sellers continue to appear whenever the price attempts to rise. Until that sequence of lower highs is broken, the market remains vulnerable to further declines. This is why the 85.40 resistance level has become so important. If silver manages to break decisively above that zone, the pattern of lower highs would be invalidated. A successful breakout would signal that buyers have regained control of the short-term trend. Once that happens, traders would likely begin targeting the next technical levels above. The first of those levels sits near 87.10, which corresponds to the 0.5 Fibonacci retracement of the previous move. Beyond that lies another potential resistance area near 89.24. These levels represent the most logical upside targets if bullish momentum returns. However, the opposite scenario must also be considered because markets often move in unexpected directions. If silver repeatedly fails to break above 85.40, the resistance cluster could push prices lower again. Traders watching the chart have identified 79.30 as the next critical support level beneath the current market. This level previously served as the breakout point during a strong rally earlier in the year. Breakout levels frequently transform into support when revisited because traders who missed the original move view them as opportunities to enter. If the market holds above 79.30, the broader bullish structure could remain intact despite short-term volatility. But if the price falls below that level, the chart would signal increasing weakness. The next support zone would appear near $78, which marks the lowest point reached during a previous failed breakdown attempt. If that region also fails to hold, silver could slide toward $76.30. Beyond that lies a far deeper support level around $72, which corresponds to a major swing low formed earlier in the year. When these levels are viewed together, the silver market currently resembles a narrow corridor where every movement is being closely watched. Above 85.40 lies the path toward renewed bullish momentum and higher price targets. Below $79.30 lies the risk of a deeper correction that could test much lower levels. Between those boundaries, the market remains locked in a struggle between buyers and sellers. While technical levels provide a framework for understanding short-term movements, another metric often used by analysts helps place silver within a broader historical context. That metric is the gold-to-silver ratio. This ratio measures how many ounces of silver are required to purchase 1 ounce of gold. Throughout history, the ratio has fluctuated dramatically depending on economic conditions and market sentiment. At times, silver has been relatively scarce compared with gold, pushing the ratio as low as 15-1. At other times, gold has dramatically outperformed silver, pushing the ratio above 100-1. At the moment, the ratio sits roughly between 59 and 62 to 1, depending on the timing of the measurement. This places silver near the middle of its historical relationship with gold. But some analysts believe that relationship could change significantly in the coming years. One projection suggests the ratio could compress toward 32 to 1 if silver's supply constraints intensify while gold maintains its current value. To understand the implication of such a shift, imagine gold remaining around $4,700 per ounce, while the ratio drops to 32. Under that scenario, silver would theoretically trade near $147 per ounce. If gold rose to $5,000, while the ratio moved to 32, silver could reach approximately $156. If gold climbed even higher to $5,500, while the ratio remained compressed, silver might approach $172 per ounce. The reasoning behind these projections centers on the differences between gold and silver demand. Gold is primarily held as a store of value and a monetary asset. Silver, by contrast, plays a dual role. In addition to investment demand, it is heavily consumed in industrial applications. Electronics manufacturing, renewable energy technology, and advanced medical equipment all require silver because of its exceptional conductivity and antimicrobial properties. As these industries expand, silver consumption could grow more rapidly than mine production. If industrial demand continues rising while supply remains constrained, silver's relative scarcity compared with gold could increase. That imbalance might naturally compress the gold-to-silver ratio over time. Of course, such projections remain uncertain because markets rarely move in predictable patterns. The ratio could remain near current levels or even widen if gold begins outperforming silver during periods of economic stress. Beyond the technical levels and ratio analysis, geopolitical developments are another factor shaping the silver market right now. Rising tensions across several regions have created an atmosphere of uncertainty that often pushes investors toward safe haven assets. Precious metals frequently benefit from this behavior because they are perceived as stores of value during periods of instability. Recent conflicts involving missile strikes and drone attacks across strategic areas of the Middle East have increased fears that broader instability could emerge. When such tensions escalate, investors often move capital into assets they believe can protect purchasing power. Silver experienced its recent surge toward 96.93 during exactly this kind of environment. However, geopolitical premiums rarely last forever. If tensions begin to ease through negotiations or diplomatic breakthroughs, the urgency driving safe haven demand can fade quickly. This dynamic helps explain why silver spiked dramatically and then dropped nearly 11% in a short period of time. Markets constantly adjust to new information, and sentiment can shift rapidly when traders believe the worst-case scenario might not occur. Because geopolitical developments are unpredictable, they add a layer of uncertainty to the silver market that cannot be modeled through charts alone. Diplomatic progress could reduce demand for safe haven assets, while further escalation could trigger another surge of buying. Traders must therefore balance technical analysis with awareness of global events when evaluating the market's next move. Beyond the technical structure and geopolitical developments, there is another issue that investors have been discussing with increasing urgency. It involves the growing disconnect between the official paper price of silver and the actual cost of obtaining physical metal. Many people following the market have noticed something unusual. While futures exchanges may quote silver trading around the mid-$80 range, anyone attempting to purchase real coins or bars often encounters significantly higher prices. Dealers in multiple countries report strong premiums above the spot price, and retail buyers in several regions have been willing to pay those premiums simply to secure physical silver. This difference between paper price and physical price is not new, but the size of the gap has drawn renewed attention. For decades, the global benchmark price for silver has been determined primarily through futures trading. Large institutions, hedge funds, and algorithmic trading systems buy and sell contracts representing enormous quantities of metal. These contracts influence the price that appears on financial terminals around the world. Yet the majority of those trades never involve actual silver changing hands. Instead, the contracts are closed or rolled forward before delivery occurs. As long as most participants are content trading paper instruments, the system functions smoothly. The paper market determines price discovery, while physical silver remains a small portion of total activity. But the situation begins to change when a growing number of participants demand delivery of real metal rather than settling contracts in cash. When that demand increases during a period when inventories are already tightening, the system can experience stress. This is precisely what recent reports from the exchange appear to indicate. Trading disruptions occurred when sell orders temporarily exceeded the amount of registered inventory available to support delivery obligations. Registered inventory represents the silver specifically designated for delivery against futures contracts. It is the portion of exchange stockpiles that ensures the integrity of the delivery system. When that inventory begins shrinking relative to open interest, the margin of safety within the market becomes thinner. The disruptions did not last long, but their significance should not be underestimated. For years, analysts have speculated that the silver market might eventually encounter a moment where the balance between paper trading and physical supply becomes strained. Those concerns were often dismissed as theoretical, yet the recent events suggest the first signs of that tension may now be emerging. The question facing the market is how this tension ultimately resolves. One possibility is that the official paper price gradually adjusts upward so that it more accurately reflects the scarcity of physical silver. Another possibility is that exchanges maintain control of pricing through mechanisms such as higher margin requirements, position limits, or incentives that encourage traders to settle contracts in cash rather than demanding metal. Markets have navigated similar tensions before, but the timing and outcome of such adjustments are extremely difficult to predict. Against this backdrop, it becomes useful to outline the potential scenarios for the coming sessions. The first scenario is the bullish path. In this case, silver holds the support zone roughly between 80 TAs and $84 and gradually builds upward momentum. Buyers continue defending the area that stopped the previous decline, and the price begins pressing repeatedly against the resistance cluster near $85.40. Eventually, the market breaks through that barrier with a decisive close above the moving averages. Such a breakout would signal a shift in momentum. Technical indicators would likely confirm the change as the relative strength index climbs above the midpoint and the MACD begins crossing back into positive territory. If geopolitical tensions remain elevated at the same time that economic data weakens the dollar, the combination could provide additional fuel for a rally. Institutional investors, recognizing the structural supply deficit, might step in to accumulate positions. Under that scenario, silver could climb toward the next resistance levels near 87.10 and 89.24. If momentum continued building, the market might even challenge the previous spike near 96.93. Such a move would likely attract significant attention across financial media and could trigger another wave of speculative interest. The second scenario is the bearish path. In this version of events, silver repeatedly attempts to break above $85.40 but fails each time. Sellers continue appearing at the resistance cluster, preventing the market from establishing sustained upward momentum. Meanwhile, the pattern of lower highs remains intact, indicating that the balance of power still favors sellers. If geopolitical tensions begin easing or economic data strengthens the dollar, safe haven demand for precious metals could weaken further. Traders who purchased silver during the recent dip near $82 might decide to take profits rather than risk another rapid decline. As selling pressure increases, the price could slip below the $79.30 support level. A break beneath that level would be technically significant because it would signal that the previous breakout zone is no longer holding as support. The next downside target would then become the $78 region. If that level also fails, the chart suggests the possibility of a deeper decline towards $76.30. In a more extended correction, the market could even revisit the major support area near $72 that formed earlier in the year. Both scenarios remain plausible given the current environment. Markets rarely move in a straight line, particularly when multiple forces are competing for influence. Silver has always been known for dramatic swings, and recent movements have reinforced that reputation. The 11% drop that followed the spike near 96.93 serves as a reminder of how quickly sentiment can change. Another factor that traders are watching closely involves economic data from the United States, particularly employment statistics. Strong job growth often strengthens expectations that interest rates will remain elevated. Higher interest rates tend to support the dollar, and a stronger dollar can place downward pressure on precious metals because they become more expensive for international buyers. Conversely, weaker employment data may increase expectations that central banks could eventually reduce interest rates. Lower rates typically weaken the dollar, which can support precious metals by making them more affordable globally. While economic reports can influence short-term price movements, many analysts believe geopolitical developments may carry even greater weight in the current environment. Military escalation, diplomatic negotiations, or unexpected political announcements can shift market sentiment rapidly. Because financial markets close during the weekend, sudden news events may cause large gaps when trading resumes. This possibility is another reason why risk management remains essential for anyone participating in volatile markets like silver. Looking at the broader picture, three major conclusions emerge from everything discussed so far. The first involves the growing pressure within the silver delivery system. Registered inventories appear to be tightening while delivery requests increase. Trading disruptions have already occurred when the balance between paper contracts and physical supply briefly broke down. Combined with multiple years of global supply deficits and export restrictions affecting refined silver, these developments suggest that the market's structural shortage may be becoming more visible. The second key takeaway is the importance of the $85.40 technical level. This price represents the convergence of several major indicators and acts as a dividing line between bullish momentum and continued consolidation. A decisive move above this level could open the path toward higher resistance targets, while repeated failure beneath it could keep downside risks alive. The third major factor involves the gold-to-silver ratio and the possibility of long-term compression. If silver's industrial demand continues expanding while supply remains constrained, the historical relationship between gold and silver could shift. Some analysts believe that a much lower ratio could eventually push silver prices dramatically higher than current levels. While such projections remain uncertain, they highlight the potential impact of structural supply imbalances. In the midst of these possibilities, one principle remains critical: disciplined risk management. Silver's volatility can rival that of some of the most aggressive asset classes. Large percentage swings can occur within a matter of days. Traders entering positions without a clear plan may find themselves reacting emotionally to sudden movements. Before entering any trade, it is important to define where profits will be taken and where losses will be cut if the market moves in the wrong direction. These decisions should be made calmly in advance rather than during moments of extreme volatility. Markets reward preparation and punish impulsive decisions.